Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by BetaShares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, BetaShares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with BetaShares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast.
Of the Australian Finance Podcast. This is our weekly Q&A session. Today I'm joined by Tahli, one of our senior advisors here at Rask Advice, because Owen is off on leave and we are trying to keep him actually out of the office, out of his emails. So very excited to have Tahli here joining me for this week's Q&A. How are you, Tahli?
Yeah, I'm good. It's good to be back.
Yes, we love having you on the podcast, and we have some really amazing questions. We've had lots come through and I've picked out, I think I've got 4 today, but there's some pretty juicy ones. So I'm very excited to get into this. But we always like to start these sessions with, what have you been up to? How's your week been going?
It's been a really good week. The advice side of Rask has been absolutely pumping, which is a good thing. And we're getting to the point now with the advice business where we're having our first, series of coaching sessions. So with Rask Advice, we're doing quarterly coaching, and because we kind of had our first clients onboarded, 3 months ago, we're having the first of those sessions now, which has been really nice. I had one last night that absolutely filled my cup, and I know they'll be listening to this. So thank you to you both for a wonderful session. And we were just really talking about, we spent a lot of time talking about money mindset, and it wasn't, the intended conversation, but it just kind of happened naturally. And talking about like the reasons behind having that scarcity mindset for one partner and then the other partner being a bit more of that abundance mindset, and realizing that combination is so perfect. Although it can mean at times like you've got very different opinions to things, they actually balance each other out really well. And they're, in terms of their like long-term plans and everything, they're really on track to hitting all of their targets, and they just needed a bit of reassurance again that they were doing all the right things. But yeah, it was a really great conversation. So that's made my week. How about you? How's life?
I absolutely love that. Well, I've had some great coaching clients as well this week, which has been great. But I totally get that like adrenaline kind of, just absolutely fills your cup. And you're so right about different mindsets. Yes, they can cause like some friction, but if you actually understand them, it can be a superpower and you can both really use them to your advantage. So absolutely love that. Yeah, this week has been a little bit hectic, but very, very productive. As I said, Owen's on leave, so we're trying to keep him out of his emails and the business so he can actually enjoy his family holiday. But yeah, excited to get into this Q&A. So before we start, as always, for our listeners or those watching on YouTube, these sessions are general education only. So they are for information, education, entertainment purposes. It's not personal advice. We may talk about different products, strategies, things. It's really, really important that you assess if they suit your goals, needs, objectives, if you might need advice or just to do a bit more research yourself. Anytime we talk about a product or you're thinking about a product, you'll need to look at like the product disclosure statement and any other supporting documents so you can make that decision. But anything we talk about today, just take it as education, might inspire you to start looking into something yourself. But let's get into it. So Tahli, you've done these a couple of times before, but just a bit of a recap. So we love people to send in a funny name and have their question. And so let me read them out and then we'll get, your take. So this first one is from Anti-Taxa. Love it. What does it mean when you go into pension mode with your super? I hear this a bit. I believe the income you generate from super when you do this is tax-free, but how does it actually work? Are there restrictions on how your super is invested once you move into this phase? Thanks and love the podcast. And then they've put their real name, but we're sticking with Anti-Taxa. Perfect. Okay, Tahli, tell us, what is pension mode?
It's a great question. And I love this one because it is so confusing for a lot of people. And it's like this mystical world of super where we talk about this pension mode, but not many people know what actually happens in that space. So the pension mode, it is also referred to sometimes as an allocated pension, an account-based pension, a retirement income stream. And there's also other things like that are slightly different, which are called transition to retirement schemes, or transition to retirement income stream, which we won't go into today because that's another beast.
Whole episode.
Yeah. Yeah. But within this environment, this is like where you get the peak superannuation benefits, because the income generated, and when we say the income generated, we're talking about the earnings within that investment. So that's your capital growth, if any of the capital growth is realized, but it's also the dividends or the distributions that are generated from those investments. That all becomes tax-free within that account-based pension phase. And the withdrawals that you make out of that account are also not taxable to you personally. So that's kind of the key reason why we consistently harp on about superannuation and why it's so important, because you obviously won't get those sort of tax implications elsewhere. And then speaking to the investment options part of the question, so within an account-based pension, it can really operate the same way as your accumulation super. So if, for example, you're invested in the balanced option within your super whilst accumulating and putting money in, when you flick it over or, submit the paperwork to request a transfer into the pension phase, you can invest exactly the same way. So you could still go into, if you wanted to, a growth option, a balanced option. You might go into a conservative option. So all of those things are still there and available. A lot of super funds are starting to introduce things like lifetime income options within an account-based pension. So you create a little bit more, consistency with your returns. But really what we kind of encourage is that when you do transition to this phase with your super, it's a really important time to check in on how you invest. Because what you were doing during your accumulation years might not necessarily be the best option for you when you start pulling money back out.
Yes, absolutely love that. And I think there's a huge misconception that people think when you go to pension phase that it's no longer invested. But yes, it absolutely can be. And when we talk about your time frame, you might do this from 60 or 65. Your investment time frame for the bulk of that money could be 20, 30 years. So it still makes sense to have growth assets in there. You just need to find your comfort. But yes, absolutely love that. So think of your superannuation when it's in accumulation phase as like a bucket. It's filling up, where when you go into pension mode, it's a tap. Money has to come out of it each year. And the benefit of drawing money out of it, even if you don't really need it, is that you get tax-free earnings and that money comes out tax-free and you get to do something with it. Another thing that I see that drives me crazy is I'll see people that are over 65, like maybe even 70 or something, and maybe they're still working and they haven't gone to pension phase because they're like, oh, I don't need the money. And I'm like, but if you did move to pension phase, you would have tax-free earnings and tax-free income, and you could do something with that. So one tip here is if you're in accumulation, you might be 90. If you're sitting in accumulation, you are going to be paying the 15% earnings tax, or up to, on your returns. It's not based on your age. It's based on it being an accumulation fund versus a pension fund.
Yeah, that's such an important point. And people, if they don't necessarily, quote, need all the money yet, they don't have to transfer all of your super into a pension phase, because obviously there is a minimum withdrawal amount that you have to take out once it's in pension. So you might only put part of your money over into that phase once you know how much you actually need to start pulling back out.
Yeah, Yeah, and as long as that money comes out, at some point within the year, you might choose it to be fortnightly because that's how you always worked your budget or how you're paid when you're working. You might choose for it to be quarterly or even just once a year. As long as that minimum amount comes out once a year, you're eligible for all those benefits of pension. So that is a great question. Thank you, anti-taxer. Lots of benefits for superannuation after 60. This one comes from Daddy to Be. I have a question about investing for your kids. Could you explain how you would go about passing the money on to them? For instance, if Charlie turns 18, so Charlie's Owen's newborn, if Charlie turns 18 and you've invested about $50,000 for him, how would you transfer that investment into his name and what are the tax implications that might arise? It's a great question. Tahli, do you want to go through this with us?
Yeah, I love this one as well because it comes up all the time with advice clients, and it's always, the intentions are good, but sometimes there's ways to be more tax effective, which is obviously what this question is kind of implying or hinting at. So if you were to create an investment portfolio under your own name with the intent that, down the track when Charlie's 18, you wanted to transfer that portfolio over to them, even if your child is not paying you to receive that money or that portfolio, in the ATO's eyes, they see it as you triggering a sale event because the ownership changes. So in their eyes, you've received the market value of that portfolio and therefore it is taxable to you. So something that people might do instead, or something that we're seeing more of at the moment, is brokerage accounts offering you the option to invest in like what's called a minor trust account. So you're investing on trust for your kids. And in this structure, technically, the child is the beneficial owner from the get-go, which means that once they turn 18, you can transfer the ownership over to them. And because it's not necessarily changing the beneficial owner at that point in time, there might not be the same CGT tax implications that you would otherwise have. But it's really important with those that because the child is the beneficial owner right throughout, that means the earnings throughout that term are taxed at their marginal tax rate. So they're subject to those minor tax rules, which is something we typically want to avoid. So there are a couple of alternatives as well that we're seeing pop up a little bit more nowadays, which might be investing for your kids in something like an investment bond or an education bond. And with those structures, you can nominate a future transfer date. And with those particular structures, because they're unique in that the transfer of ownership doesn't trigger a tax event for you personally, because they're what's called tax paid investments. So throughout the term of that investment, the provider of the investment account is paying tax at the company tax rate, or perhaps and most often slightly lower than the company tax rate. And then when you transfer over to the child, there's no tax implications then. And provided it's been 10 years, they can start to withdraw money out for themselves without paying tax personally too. So it's a
So and we get a lot of questions about bonds and things as well. Yeah, but I really like the children's accounts. So like Perla's got one. They're a sponsor of the show. Razor's got one. Depending on the type of setup, you can also do a minor's account that while they're under 18. It's taxed in the adult's name and then it transfers to them when they're 18, and that won't cause a CGT. So one of the kids types of accounts, but you have to really make sure that you're getting the setup right. And the other thing that so I talk about quite a bit, my kids' investments. So they've got share investments, but it's in our family trust, just because I already had that set up. So that if I actually want to gift that money to them, there is going to be a tax event there because they're not the beneficiaries. So yeah, there's lots to consider. But you definitely can do it. You want to make sure that you understand the implications if it is definitely their money or if it's like family money, how I kind of consider ours. I'm like, yes, I want it to be for you, but if something came up, if we needed that, it's family money. I'm using it. But yeah, the goal is that I will be able to gift it to them. But absolutely love this. The only thing I would add is lots of people want to invest for their kids, save for their own kids. Put your own oxygen mask on first. Make sure your own finances are under control. There's so many things that you can do to help your kids financially just by talking to them and educating them and having conversations about money. You don't always need to be saving and investing for them if you don't have capacity right now.
Yeah, that's such a good point.
Perfect. Next one is, this question comes from Newbie. Long one here, so please bear with me. Can I salary sacrifice into my partner's super, or does it have to be after-tax contribution? If so, whose cap does it go under? And am I able to use those funds I added to my wife's super to withdraw for the first home super saver scheme? Okay, quite a bit here. All right, quickly, can you salary sacrifice into your partner's super?
Quick answer, no. So there's a few different ways you can move your own contributions over, or there's one way you can move your own contributions over to your spouse's super, but you can't directly salary sacrifice into theirs.
Yes, exactly. So they can salary sacrifice. You could use family money and they could have it come off their taxable income. Or you could do what's called a super split, and it's that your salary sacrifice or your super contributions, you moved them over, but it stays under your cap and it does go in as an after-tax contribution. The next part of that question was, whose cap does it go under? So if it's that you put family money in and they claimed a tax deduction, it would go under their cap. And if you did that super splitting where you moved some of your contributions over up to 85%, that would still stay under your cap.
Yeah.
Is that right?
Yeah, no,
Anything
exactly.
to add there?
No, bang on.
Now, the next part of their question is, am I able to use the funds I've added to my wife's super account to withdraw for the first home super saver? Tell us about that.
So with the first home super saver, funds that can be used for that are your additional personal voluntary contributions. So your
so many long words.
So what you could do is use, again, like family money to contribute into your spouse's super, and then record it as, your spouse's money going in, and that way your spouse can pull the money back out for the first home super saver scheme. But yes,
because you have a cap each. Like, so for the first home super saver scheme, God, that's a ridiculous amount of S's. You have, like, the limit is 50,000, a cap of 15,000 per year, up to 50,000 can be contributions can be pulled back out, but you get that each. So you could be doing it in your super and you could be doing it in your partner's super, and essentially, 100,000 limit together for that, for your first home. So you could be maximizing yours and maximizing hers and working together.
Exactly. Yeah.
I love the super questions, but they are so complicated as well, especially when it comes to contributions. I just hope that we're not confusing people. Okay, the next one comes from, absolutely love this name, Walrus Buffett.
Love.
Oh, we get some crackers. Okay, when is using a credit card a good idea? How can it help me as a young investor? Should I use it for small purchases that I instantly pay back? Thanks for your time. I have very strong opinions on credit cards, but you go first.
It's hard to keep this answer short and sweet because, I'm going to sound like a typical finance person and say it really depends. And I think it depends on your behavioral approach to money and your mindset more than anything. Yes. I know, you and I probably are a hard no.
I don't think you need it. Yes, they can add benefits. And we know that people nail the points and they get their free flights, and there are those people, but they are few and far between. And we see more often than not people get in trouble with credit cards. So I think if you can go through your life without having one, generally you will be much better off. I don't have one because it changes my behavior and I'm very irresponsible with it. And after 40 years of life, I have finally realized it. So I will not use a credit card because it makes me spend more. And there's statistically, it says that even if you're paying it back instantly, so you're not paying interest, there's still fees. There's annual fees. There's fees every time you tap. There's also research that tells us that when we use a credit card or some kind of facility, Afterpay, buy now, pay later's credit, that our brain is happy to spend 18 to 40% more than it would if we were using our cash. So they are designed to have you spend more. Yes, you may be one of these few people that can make them work for you, but if you don't need it, if you're going to pay it back instantly, like, why overcomplicate things is my kind of opinion there.
Yeah, I agree, to be honest. I think the additional points and incentives you get for hitting certain spend amounts too, it fuels this fire. And like you said, more often than not, I see credit cards doing more damage than good.
Yeah, the banks are in the business of making money. They don't give you things that they think they will lose out on. But the other thing is, what's your opinion on this? Because a lot of people will say, I want to get a credit card to build up good credit for when I eventually get a home loan. What are your thoughts on having a credit facility to prove that you're good with credit?
Again, I would have to disagree. I don't think you need a credit card to have a good credit record. And, I can speak from personal experience as well with that. My first home loan, I'd never used a credit card before, and my credit rating was fabulous. And that just comes from little things like having never defaulted or, I guess, failed to pay a bill on time,
Yes.
All those little things that you do add up, and you don't need the credit card to prove that you've got a good credit score.
Yeah, so many things go towards that, like paying rent, paying your phone bill on time. All of these different things can build up good credit. You don't need to have a credit card or a personal loan to do that. And most of the time, they negatively impact you more than they can positively. So what I mean by that is, you miss one payment and it's made a negative and you've just undone all that hard work. So I would really think about the reason that you want one if you are the person that is going to make the points work. And if you are somebody who wants to try having a credit card because it may work for you, I would be putting a reminder in your diary, maybe every 3, 6 months, 12 months, to have a very hard look at your spending and a hard conversation with yourself and going, is this actually working or is it not? And if it's not, cool, shut it down. You've tried it and it might be like me, it's not for you, but don't let it, like me, have it for 15 years before you decide this isn't working. So just have check-ins with yourself. It's like your budget. It's not going to be set and forget. You need to check in and see if things still work for you and really challenge why you're doing it.
Yeah.
But Tahli, thank you so much for joining me. So we had some great questions. We had anti-taxer asking about super pensions. We had daddy-to-be asking about investing for kids. Newbie was asking about contributions to super, first home super saver scheme. Absolutely hate that. And we had Walrus Buffett asking about credit cards. We got a little bit ranty about, or I did, but I'm just very passionate about that. But big tip, if you're going to try it, absolutely try it. Just keep yourself accountable. Do those check-ins. This was very fun. Thank you for joining me while Owen was away. And I look forward to having you on the podcast again soon, Tahli.
Thanks for having me. And hello, Owen, if you're listening. I hope you're having a wonderful time off.
In Palm Cove, hopefully sipping Mai Tais by the pool.
Yes, love it.
All right, see ya.
Thanks, Gemma.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel, or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.